Mitch, you called the 2024 bull market, but this market's a bit different, isn't it?
Completely different. Bitcoin hit 126,000 in October. We've now drawn down 50% to 60 to 70,000 in just a few months. People are being guided by fear and hysteria. The fear and greed index is at 5. The data and technical signals are telling a completely different story. I'm looking at 3 key technical data points and technical analysis points that I'm going to use to understand whether we're entering a bear market or whether we're about to get a massive leg up across the next 6 months.
Welcome to Crypto Coach Will, where we bridge the gap for everyday investors wanting to build real wealth in crypto. I'm Will Wright, the founder of Mining Store and Imperial Wealth, 2 of Australia's leading companies in the crypto space. For over a decade, I've helped everyday investors safely and securely set up in the cryptocurrency market so they can build long-term sustainable wealth. In this podcast, we break down the complexities of the cryptocurrency market, everything from investing, trading, DeFi, and even Bitcoin mining. Let's get into it. So Mitchell, unpack the cycle so far. What have been the main turning points? How's it different this time?
Yeah, so I think the obvious main point for this cycle, it's been a Bitcoin-driven cycle. Obviously, at the start of 2024, I believe in the first week of January, we had the ETFs introduced, which obviously for the prior cycles, I remember in the last cycle, I think we had the futures ETF approved and everyone was kind of hanging out for it as that next catalyst. And really it was. I think they got introduced around 38K BTC. And from there on out,
Take me back.
Yeah, literally. We're almost back there.
Could be back there soon. So.
Which we'll talk about a bit later because it's pretty interesting what lines up with a few technical levels, that kind of entry point of the ETFs. And ever since then, really what happened with this cycle, different to last cycles, is a lot of the momentum in the markets and the altcoin markets was retail driven. This cycle was vastly different because it was institutionally driven. And what that was corporate treasuries, institutions, companies getting allocations to the ETFs through BlackRock, through Fidelity, whoever it was, and adding it to their balance sheets or stockpiling. And even retail clients, they were able to get that kind of traditional finance avenue into the ETFs, and really they were the marginal buy of Bitcoin. And that's really the most simple explanation as to why largely altcoins haven't driven as high as prior cycles. Obviously Ethereum is the other one, which got to an all-time high just briefly at $5,000. It didn't quite eclipse the prior all-time high like Bitcoin did. But yeah, I think that's probably the main talking point of this cycle, what it was and why it was vastly different.
I think the biggest mistake that people make is when the market crashes, they completely change their strategy. Their psychology gets flipped and they start making poor decisions. Retail decisions is probably how we would describe it. And selling into the market. So towards the end of the episode, I want to go into a little bit more about those key mistakes that people are making. But for the moment, talk me through probably the biggest question on people's mind is we've had a massive crash recently. What's actually caused this crash?
Yeah, so I think, the funny answer to this question is no one knows, and that's the truth, because there's a plethora of reasons as to why the market has crashed. You probably can't put your finger on one. Obviously, the main instigator of it was the 10th of October liquidation crash, in which there was heavy tariff and geopolitical news that came in for us Australians overnight, which saw Bitcoin tumble from as high as 120K to as low as 102K, I believe, in a matter of hours. I think it was a couple of minutes. We're talking from 110 to 100 or so. So we haven't had kind of one of those flash crashes in a long time because of the stableness of the market, because who was buying, not too many people selling, and really this was fueled by ETF unwinds a little bit, but more importantly that large cohort of OG sellers and whales that cyclically follow usually and sell in Q4 of that post-halving year. I think that cohort alone sold over 30 billion in Bitcoin. And just to put that in perspective in that short time frame, in total, the ETFs have only sold 8 billion since the top to now. So in a matter of weeks, the actual real people that hold Bitcoin from cycle to cycle or from the early 2010s, the mid 2010s, they sold 30 billion.
Do you think that they work together to crash down the market?
Yeah, they could. And I believe it's how the market used to work, for sure. I know we've showed that chart to our clients and maybe on a few of these podcasts where you can actually see the retail mania, that kind of parabolic kind of momentum that Bitcoin had. It would always sell off. It would diagonally go down and you'd see it again. When you see the buying and the selling this cycle, it's vastly different until we really got to this point, which really mirrors the 2022 top. in both oscillators, in price action, so on and so forth. But I think the difference is that it is macroeconomically based, and I'm not going to sit here, even though we've had this crash, to say that, you know, Bitcoin still operates in 4-year cycles, because in the past it did on liquidity, on business cycles, on macroeconomics. And we've just had a few kind of outliers that have occurred in the past few months that have probably fueled this crash more to kind of trick people into thinking we are cyclically moving in still Bitcoin native 4-year cycles. But to me, it actually, regardless that this price actions happens, never been more obvious that we're still moving in a liquidity regime. And really, to add to, you know, those initial points, there was the metals rotation, the stock market rotation. And I think the most clear point as to why we've sold off so hard is that we're not really that digital gold at the moment. I think that was my mistake. It was probably your mistake. It was 99% of our mistake in believing that most people were getting exposure to Bitcoin as that kind of debasement trade. But really, when that debasement trade came in 2025 and the USD dropped over 10%, which is a huge amount, which Trump wanted, which the US administration wanted, is that rather than prior cycles where the DXY did come down, or the USD, sorry, and Bitcoin went up, all that money, all that hedge, all that debasement trade went to gold and silver, which have gone absolutely parabolic. People actually went to risk off assets such as metals, such as the S&P 500, such as the Dow Jones, which reached an all-time high the other night. And, you know, the most clear thing to me is that we trade as like a tech stock, like a software stock. We're still very in that speculative stage. It is what it is. And if you go take a look at software stocks such as Microsoft, Google, whatever ones you want, they're down equally as much as Bitcoin, you know, a bit less. But if you go and look at the ETF chart of software through BlackRock, it is the exact same chart as Bitcoin. So
super interesting that you bring up, you know, is Bitcoin the answer as like the digital gold? I think that's my long-term vision, right? I'm not naive in the sense that I think that an asset that's been around for 15 years can completely replace that. And I still think that's what the institutions that are acquiring it and MicroStrategy, they're seeing it as the long-term. So it does make a lot of sense, doesn't it? That, you know, if this debasement is happening right before our eyes, are you going to go into your golds and silvers that have been around for 40,000 years?
Exactly.
Or are you going to go into it? But yeah, I think that to kind of recap what has made this crash happen, potentially a bit of systematic sell-off by the institutions, a bit of foul play or manipulation was definitely put out there, but also that massive pullback that we saw on gold and silver.
Yeah, and, you know, one thing I want to touch on, that just given that we're talking about from cycle to cycle and why I believe this pullback is different, is it's the same as the run-up, and the fact that these institutions are involved in Bitcoin now, whereas Bitcoin, when it didn't have the institutions, it was a momentum asset in the fact that all you could trade it on was the spot markets and perpetual futures. So what happened was, when Bitcoin used to go up a lot, and this is why it doesn't happen anymore, is that we used to get these huge, large short squeezes, because that's the only way you could really bet on it going down. And when the spot market drove the market up and funding changed from negative to positive and we started to rip these shorts, that's where we got those God candles that we so dearly miss. What people need to understand is that Bitcoin has moved from a largely momentum asset to a yield-bearing asset now, where these institutions aren't stupid. They don't just buy the ETF and they go, oh, I'm just going to expose myself to the risk-on asset on this planet. What they're doing is they're using options, they're using various models that allow them to create a yield-bearing position where they introduce delta neutral strategies where they'll have covering calls or whatever it is on Bitcoin to hedge against that risk of that volatility that's going down on that volume. And this is actually what fueled the move down as well, because so many of them sit on the other side, these options unwind, and that's why you actually see price actually to the downside move quite volatile, but on to the upside not as much.
Okay, it's interesting. Look, I want to get into the technical levels that we're looking at, you know, where we always say no one knows what price is going to be tomorrow, but you can use technical analysis to create a bit of a map. So I do want to get into that, but you and I are having a really good conversation the other day. Another factor before we leave this topic of what caused the crash is potentially people misunderstanding quantitative easing and interest rates. Do you want to quickly run over that? I think that's really, really important.
So obviously, you know, Bitcoin as that risk-on speculative asset, and it's the exact same with software, what I was mentioning before, is that they're a barometer of liquidity where, you know, when liquidity gets influxed into the system through money printing, through M2, through various methods of cutting rates, this is when these assets that are the most risk-on assets go up. And then we can even extend this to altcoins. And like I said, why Bitcoin and these assets are based on macroeconomics and liquidity is in the past, we had quantitative easing. In 2019, we flipped and there was an interest rate cut and the markets shifted from QT ending to QE beginning. That ran the whole way through to COVID. We then had a ton of money printing through stimulus, another form of QE. And this is why assets like Bitcoin, Ethereum, altcoins, the stock markets, tech stocks absolutely exploded because we actually had QE. But what people are getting confused with now is just equating interest rate cuts to QE. They're not quite the same thing. Yes, the borrowing rate of money gets lower, but yeah, the sticking point here is obviously Warsh, the new, I think that's how you pronounce his name, Warsh, the new Fed chair that's expected to take Jerome Powell's place. Rest in peace, Jebediah.
You will not be forgotten.
Oh, well, the thing is, we probably want him out, but, you know, I do miss some of those older Democratic fellas. I wouldn't be ashamed of saying I miss Biden a little bit now, given what Trump's done with us, but yeah, just going back to it is that, you know, he's quite a hawk in the sense that he's wanting to cut interest rates like Trump wants him to. But as I said, this doesn't always equate to QE because he wants to shrink the Fed balance sheet, not expand it, which is pure QE. You know, we won't get too technical and explain it all, but obviously this is to do with various buying US treasuries and buying them back off investors once the yield of those comes down through those interest rate cuts. But I believe they don't really want to do that, or he doesn't want to do that because he doesn't want to overinflate the economy to a point where inflation is going up.
Yes,
he really wants inflation to stay very low. And so he's willing to cut rates but not do QE. And Bitcoin does not outperform just because interest rates are cut. It outperforms when there's QE. A form of QE is interest rate cuts, but only if the Fed is expanding their
That's it. Look, he can keep the man that pretty much gets him into the job happy, Donald, and get the interest rates down, but he's not willing to let so much money flow into the economy that it's going to cause inflation go up. And really, that flow of money into the economy through the QE, that's what you need for Bitcoin to go up, right?
Yeah, and I think that's kind of why people got caught off guard with that M2 Bitcoin correlation as well, is because the US in particular, which is M2, like liquidity's been going into the system, but not in the way you think. Not in a QE way, just trying to think of my terminology here, but in the sense that, it's not like price cycles, or it's not in the form that you think it is. And this is why people are getting very confused when interest rates are cut and these things are happening, is because we're not in a regime of quantitative easing just yet. And I don't know whether we will be for some time unless that inflation number really, really comes down, which interestingly enough, we're getting tonight as we, probably 10:30 p.m. or 11:30 p.m. we get the new CPI number. So it'll be super interesting to see that and the impact on markets from there.
And we'll see where it goes. Well, that's a really good summary of, you know, what the main, as you said, is a culmination of things. It's not just one thing that makes the market come down, but those technical levels. Talk me through, from a technical analysis point of view, what are the levels that you're looking at that Bitcoin may draw down to, and you know, how can people DCA at those levels?
Yeah. So I will touch on this a bit later on as well, but for now, I'm a technical chartist, as most people listening to this probably know, and I think Fibonacci retracements are a great way of beginning to dollar cost average or understand when an asset is at a discount. If you are to go and draw the Fibonacci retracements from our major November 2022 low to our all-time high in October last year, you'll see that the golden pocket, or the 618 retracement, which is a very strong reversal retracement, comes in at 58K. This also aligns with the 200-week SMA or moving average, which is, you know, historically, that is where Bitcoin, when it's under, it spends a little bit of time either there or just lower than there to represent, you know, its bear market or mid-cycle discount. So really, to me, down to that 786 area, which is about 40K, or it's 39K, which is the exact price point that ETS entered in to the market. So I think between 39K and 58K is like, well, I actually posted this in our market update to clients this week, and I said, that's my all-in BTC area, where it's like, I'm happy to invest now when it's down on a discount, because really with the flow of volatility upwards, it's also expected to be dampened downwards. So I don't want to be like, oh, well, I'm waiting for the 75 to 80% pullback in price cycles, because the institutions and ETFs 100% going to let it get to 39K. I don't know that. As you said, we can't predict it. So I'm happy to be buying in the 60Ks all the way down to 40K.
Yep.
I think that's a really good way to do it. But those technical levels of the 786, the golden pocket, the 200-week moving average, I think all in that area is just great accumulation. So
yeah, and look, if you're following the Crypto Coach Will page at the moment, you know, there's a reason why I started dollar cost averaging where I did. It was around about the 90,000 US price. We had Donald Trump coming out with his big mouth saying he's going to strong arm to take over Greenland, put tariffs on NATO countries. You know, we saw this as okay, there could be some serious price action here. It probably is going to be onto the downside.
Yeah.
As we started to dip down from 95 to 90, that's where I started my 30-day DCA.
Yeah.
Now, did I think that was the bottom? Absolutely not. You know, I was expecting price to draw down, but we never know how far it'll draw down. It could be tomorrow that some amazing news comes out and we shoot back up again, right?
Exactly.
But what we did know is we're going into a drawdown period. So that's why I started that DCA strategy when I did, $1,000 per day. That's coming to an end very, very soon. So I'm up to about day 26.
Okay.
And that exactly what you mentioned just then of that pocket around that 38 to 40K level. Yeah. If we get there, that's where I start DCAing based on like technical analysis, and it'll be larger buys. So I'll be doing like 10K buy at those levels.
Yeah, it's a great exercise because I guess it shows both the periodic way of doing it and how, you know, if this is the bottom here and your last 5 buys come in the next few days at 64, 62K, 65K and you get it good there and we go on a massive rally, like it just goes to show how periodic works. But if we are able to dip lower, then you're also able to illustrate, you know, how technical levels are used as well. So yeah, I'm the exact same as you. And I think just to touch on that quickly is that you might look at Will or anyone else that enters at this price point and think they're a fool, but really it's all based on your belief in Bitcoin and also your upside target, particularly if you think, A, this cycle's not done, or towards this end of the year, we're going to go on a massive new bull run to X target. Let's just say it's 300K. Do you really care if you're buying at 80K or 65K if the target is 300K? Probably not. Like it's a very, very insignificant difference in terms of that multiple.
100%.
And I think this is where people get so caught off as retail, or if they're following this trader and all these people, is that they try and catch the knife or time the bottom. And trust me, from 2 people that have been in this for 10 plus years,
no one knows. No
one ever catches the bottom. I'll tell you this for free. When we bought our last tranche of BTC in the bear market last year in September or November at 17K, price went to 15.5K. We didn't catch the bottom. We missed it. And I remember so clearly that when we're at 15K, every other chartist, every other analyst online on CT, or X, that's called now, we're all calling for 12K, 10K, 8K. And what happens at bottoms? No one can time it. Everyone always thinks price is going lower. Just the same as no one times the top. Everyone thinks it's always going higher because of X, Y, Z catalyst or reason, or everyone always thinks it's going lower because Donald Trump said. No one is going to be able to time it. Get your own risk profile sorted, your capital sorted, and just begin mapping out where you're comfortable to begin investing and go from there.
I think my biggest tip of being in the market for 10 years, and that's something I think everyone tries to do at the start. They try and like, I'm going to get that very bottom, and they wait. It's training your brain to have a psychological switch. And you need to understand that when the markets are drawing down, all you need to be thinking is accumulation. I'm accumulating an asset that I see long-term value in, and you can't let, that buy that I got up here is now in a loss. It doesn't matter. It's an accumulation phase.
Exactly.
As we start getting into the all-time highs, you can even go the opposite and start taking some off the table, because relative to where it's been, it's at a premium. Take some off the table. So just switching that mindset, not trying to think it as I've got to get in at the bottom so I never go into loss, and just being in accumulation is so important. So all right, so we've got a completely different market that we're in. You know, we've had a massive crash. We're changing our strategy, but what is some other things about the strategy that we are changing? How does managing a portfolio become different right now?
Specifically for us, you know, given what we spoke about at the start about how this has been a Bitcoin largely driven cycle, given who the marginal buyers are, what people are interested in, the macroeconomic backdrop, as I said, there's a lack of QE despite QT ending. You don't want to waste your time trying to pick out altcoins, micro caps, mid caps that you believe in that you think are going to go up, because the tail of this cycle is they haven't. Or if they have, they've reversed pretty quickly, and you haven't had the time or the mental capacity to watch Bitcoin continue to go up as your alt draws down. So we've decided, and listeners, it's up to you, but to focus around Bitcoin and Ethereum for now. Because why? We actually know that if the market does turn around, they're going to go up.
Yep.
You can't unequivocally say that for any other altcoin outside of those two. Now, yes, we have high conviction alts, like Solana, Hyperliquid, that we hold still, and we've got a lot of accumulation of, and a lot of our clients are still dollar cost averaging into those if they're joining, or on the recent Hyperliquid, major level at $20, we're able to communicate with our clients there that was a significant discount to us and to get involved. But yeah, I think the main focus now is keeping that tight knit portfolio. It's focusing on Bitcoin and Ethereum, and then speculating on a few high conviction alts. It's not buying 20 different ones. It's not even buying 10 different ones. It's buying Bitcoin and Ethereum, dollar cost averaging into those either periodically or at their discounts. And then when the trend shifts, and then when the market breaks, and then when we're able to actually get in a risk on environment, that's when you want to begin speculating on altcoins, because you're not going to miss out on too much. I can give you the easiest examples. We're still at 65, 70K Bitcoin, which is significant. And the last, Chainlink, I can think of, when Bitcoin was 70K last year, Chainlink would have been $20, $15. When Bitcoin went to 120K the first time, Chainlink was $33. We're at 70K BTC and Chainlink's $8. You've wasted your time holding on to that throughout the whole time. And I made that mistake with Chainlink myself, admittingly. And so you need to shift your strategy to a high conviction portfolio that isn't fragmented and diluting yourself, and also implementing particularly a profit taking strategy that you align with and that you stick to, because as we've noted, Bitcoin dominance just continues to trend upwards or sideways. Alt seasons aren't kind of on the agenda anytime soon until we see a macroeconomic regime shift, and just focusing on what will go up. So
that's it. And I think the way that I see it is there's plenty of risk to reward in Bitcoin, and it's so much more of a sure bet. It's down 50% right now, and it's, in our opinion and many people's opinion out there, a much surer bet in the long term. Whereas if you go something maybe even less sure of bet of Chainlink, whatever coin that you used to be tied to in the previous bull market, then there's a chance that just doesn't recover. That's a massive trap that people fall into. They build exposure to projects that actually aren't going to recover, thinking, it's at a massive discount, whereas really you could have just been doing that with something like Bitcoin.
Yeah, well, I'll put the task to most listeners out there that are querying whether they, it might be recently that instead of Bitcoin and Ethereum, you've been buying a shitload of Chainlink, you've been buying a shitload of XRP, Atom, Dot, whatever these old alts are that you're tied to from previous cycles. And I want you to get the chart up against BTC, not its USD pair. You can even do this with XRP, because XRP is it's great. It went from, the bottom of this cycle was 30 cents and it's $1.30 now, as high as $3. So it went high as a 10x. It's still up a 4x right now. But it was $3 in 2017. So when Bitcoin was $10,000, $5,000 in 2017, that's up at 10 to 12x. XRP is down 50% against Bitcoin. Well, more, sorry, way more. So the chart of XRP, whilst it kind of looks like this cycle and it's had a pullback, if you did it against BTC, it's just like that. If you did it with Chainlink, if you did it with, look at the ETH-BTC chart from its all-time highs in the last cycle to now. It's even though that's gone up and it's still sitting at a decent price, it's just trending down, and every altcoin permanently will trend down forever against Bitcoin. We know that for sure, and this is why you need to have a strategy in place where you're exiting at the right times when they pump, because they're going to retreat and they're going to go back down, and it's why we want to focus on BTC in particular.
Just quickly, if you're ready to take your results to the next level, my team at Imperial Wealth Crypto can help. Inside our Crypto Academy, you'll get access to my personal portfolio, strategies, real-time market insights, and the exact plays my team and I use to stay ahead. With our team of analysts monitoring the markets 24/7, we've helped investors catch moves like a coin that's done a 5x in 4 days. If you're serious about accelerating your wealth, click the link below to book in a call with my team of experts and see how we can help. Now, back to the episode. You need to understand most altcoins are coming out with a new technology idea.
Yeah.
It's a test run, it's a trial, it's not a proven product, right?
Yeah.
And so during a certain period of time, they are the winner, and
Yeah.
people are speculating on that to be the next big thing. But then an outperformer comes out, and that's exactly what we saw with Atom and Polkadot in the
Yeah.
previous cycles. They got smashed by newer layer ones and layer twos that came out in the next cycle. So in their cycle, they absolutely outperformed Bitcoin.
Correct.
But over time, they go to dust and they don't recover. And then Bitcoin continues on its upward trajectory, and there's plenty of value in Bitcoin. Hence, right now, just DCA into what is good risk to reward. So,
Yeah, exactly.
Perfectly put. Now, there are three technical signals that
Yep.
you're looking at, and
Yep.
may seem a little contradictory because we're saying you can't pick the bottom, but
Yeah.
there is analysis that you can use to help you decide, are we out of the trenches? What are those three technical signals that you're looking at right now?
Yeah, so I guess if you're looking for a shift in momentum, the most simple one to me that's the easiest to learn, to identify and to follow along is market structure. And what market structure is there's bearish market structure, which is when price action on a medium to high time frame, or even on a lower time frame, but right now it's experiencing medium term bearish market structure, where from our 126k high to our current low, you'll see that every time we had a vast drop, we had kind of a dead cat bounce where we formed a lower high, we then formed the next lower low, lower high, lower low. So for the first signal to me to get risk on again, and I guess this is when not only do I know that Bitcoin's going to go up, but maybe I can begin to speculate on alts, knowing that they're not going to just continuously wash and draw down as Bitcoin draws down, is that break in market structure. And what this is a shift to higher lows and higher highs. So eventually what's going to happen is, whether it's right now, whether it's at 58k, whether it's at 40k, is we're going to put in a major bottom where price might chop for a while. It might be here, and that's the chop we're experiencing now. We're eventually going to get some decent momentum and a price swing and a reversal upwards, and we're going to break that kind of regime of lower lows, lower highs, and we're going to begin to put in higher lows and higher highs. That's going to be the first key to me to knowing that the trend has shifted. And following the trend is the most important part. So that's the first one. The second one is kind of relative to it, but it's divergences. If you go back and study any price cycle, but in particular the 2022 cycle to now, is that when you have a divergence between the oscillators, the momentum that I'm talking about, which is a trend as well, which is studying trends, is that price made higher highs as these oscillators such as MACD and RSI have made lower lows. And that's a bearish divergence. And really that's played out to a T since we hit the top of the market to now. And that's why the price action looks almost identical. So what I'm going to be looking for, once again, is a trend shift in these oscillators, where on the weekly in particular, that's the one I've been tracking, is that we see RSI and we see MACD, whilst we put in our last lower low and hopefully begin to see price shift to a higher low, is that these begin to put in a higher low as well. And that's when you can see that selling is exhausting towards the bottom and price is likely to reverse and is reversing. So you can use that in conjunction with the market structural change. And that's when I really know that the market's becoming more momentum to the upside and it's more risk on.
Beautiful. Last one, I remember you telling me something about funding rates, was it?
Yeah, so funding rates is a bit tricky to explain, but really the funding rate is kind of the way to explain the difference between perpetual futures and the spot price and how you can keep them kind of together. And the way that's done is that, for instance, right now, most funding rates are negative, which is usually what happens in a huge crash and downturn, right? Because logically all the longs are wiped out and most of the momentum is through the shorts that are still held in the market. Right now, I think there's a ridiculous ratio of longs to shorts in the market, because there's people that are short from 126, 100, 90, 98, 80. Not too many people are long. Well, probably a lot of people are long now, but right, there's only a very short gap of liquidity from our low to where we are, $5,000 price difference. And so right now, bears are in control because majority of the shorts are in the market over the longs. So shorts are paying longs right now. Once again, using the market structural shifts, using the oscillator shift, is eventually you'll see that when a major bottom's put in, we'll be able to squeeze these shorts out. And you'll be able to see that when we break that lower low and put in a higher low and then a higher high, that you'll see funding rates begin to turn positive as we squeeze high. And this is another key signal of getting risk on and probably adding some more risk to the market, because there's two ways of really investing. You can dollar cost average and not try and guess the bottom, or you can actually wait for a positive outcome and the risk on environment to get born. Yes, you're probably going to be buying a bit higher, but the added benefit of that is a bit more of a safety net where you know the trends change, where you know that probably unequivocally price isn't going to just dump lower. There's an actual trend shift, regime shift. And so, yeah, that's the other one as well.
No, it's really perfectly put. And like, these are the things that the average person out there, they don't have the technical understanding to be able to pick out these things and track these things. And I can personally speak on that. You know, I'm literally relying on your analysis to make these decisions, and it makes life so much easier for me and for our clients. So I'll be staying in very touch with those 3 points. And look, it's, as you say, like we talk about, you're DCAing anyway down into those lows. Once you get that shift, your mentality can go, okay, maybe I am willing to take a little bit more risk with something like Hyperliquid, which I think at this point is going to be a performer over the next 2-3 years. It's at a great level. Bang, you can start doing that. So
you know, just an extra one to touch on an earlier point that we made is that, like, I'll be watching as well. As I said, like, if we can reach, you know, that 200-week MA, we can reach that golden pocket, and we do go a bit lower, I'm okay with that, because it signals to me that I'm really in the accumulation zone. And more importantly, I know that if we do chop there, like I said, most major bottoms aren't major reversals in terms of the bottom of like a mid-cycle correction. It's not like we'll hit 58K and we'll bounce to 80K in 2 days. It's usually a bit of chop like we're experiencing now. This is where time-based capitulation happens, is that people are like, oh, we're just going to keep going down. And then before they know it, we spent 2 to 3 weeks chopping between 60 to 70K and we've bounced to 80K. And so I know specifically that if we definitely get to that area, I'm going to be buying a lot more Bitcoin. And then if we break that structural shift, we begin to see those oscillators flip from exhausted to momentum. That's when I know that's the right time to buy and then add more risk to the market. So, yeah.
Yeah, and I think something that we talked about just before was the mistakes people make. So I think we've made it very clear how your mentality, your psychology needs to shift right now. We've made it very clear of different strategies you can implement to get accumulating. The big mistake, you know, that we see people make, it's something that is misused a lot, is leverage, right? A lot of people go, oh, we're at such a low level, I can put in a 10K into a trading account, put $1 million position on, pick the bottom, and all of a sudden they've blown their account up, right? So
well, it's what happens right now. Like, for instance, a lot of people in this recent few days, like a week ago when we hit that 60K, like I think we touched 64K or something this morning, they might have been long on Bitcoin 64K. Oh, I leveraged up 10 times my position size. We're at 72K. I've nailed the bottom. Price has just come back down and liquidated them. They're left with nothing. You know, I think I spoke about it on a recent episode. If you want to go watch it, like the lessons I've learned from trading, and like one of them is, if you don't understand how to use leverage, margin, risk management, stop losses, take profits, even don't get yourself involved in it, because 99% of traders lose in crypto, probably more. And you don't want to be at the bottom of that sentiment where you're left with nothing, which a lot of people are left with nothing from this cycle, the overuse of futures. So
it's such a powerful tool which can generate you cash flow at any point in any market, but it's such an respected tool in the way that you need to know what you're doing. Otherwise you're going to be gambling.
It's funny, like I remember not last year, the year before, like Binance got me on their trading stage at the convention, and the lovely lady there, she opened her line of questioning with, you know, how bad do you think leverage is? And the funny thing is both me and the two traders on the panel both said, oh, what do you mean? We think it's one of the best risk management tools you can have, because if you know how to use leverage, it actually makes no impact on what you're doing with your position sizing. It allows you to put a lesser amount on these exchanges and still have the same position sizes that you want. And from a risk management perspective, that's fantastic, because you're not open to an FTX, a Mt. Gox, whatever it is. So yeah, leverage used the right way is a really good tool. Unfortunately, as I said, 99% of people misuse it, and that's why. So if you don't know what I'm talking about, and you don't know how to utilize it properly with position sizing, 1% per trade, whatever it is, definitely never touch it. You'll remember this sentence if you do end up touching it and lose a fair bit of money. You'll go, probably shouldn't have done it.
Spot on. Another major one, and we've covered this, is, you know, chasing the dino alts. Going into projects which maybe were good in the previous rally that we've had, but then are going to be out competed by something else. They're not going to be here forever.
So the easiest way to explain this iteration of this market is there is pockets of outperformance in altcoins. The main difference is that Bitcoin used to be the lifeboat for all altcoins. It didn't matter what narrative you liked. If you held DOT, if you held XRP, if you held HBAR, if you held Litecoin, all of these in the past, there was only 500 to 100 coins in the last cycle to choose from. There's probably over 1 million coins created a week at the moment. and the amount of fragmentation, dilution in the market, is crazy. So you don't want to be getting sucked into just investing in coins that went up in the prior cycle, because they're not going to go up this cycle, and they haven't. Let's just talk about Polkadot. Like, it's $1 right now. Bottom of the bear market, I reckon it was like, I'm talking when big TC was 15K, DOT was $8. PTC 70K, it's $1. Like, as I said before,
its time.
go. The USD chart of DOT looks horrible. Put it against Bitcoin and it'll look even worse. And going back to what I was saying, is this iteration of outperformance with altcoins is based on narratives that hop from narrative to narrative. That's why you need to sell coins. Asta's a great example. Hyperliquid's a great example. Zcash and XMR on the privacy narrative are a great example. Meme coins are earlier in the cycle. Great example. All of those meme coins are worth zero now because people still probably holding them, hoping that meme coins come back. They might never come back. It hops from narrative to narrative, and you need to be very selective in what you pick. This is what we said before, and understanding what narratives and catalysts are at the forefront of investors' minds, because that's where you want to be. You don't want to be in DOT. No one cares about interoperability anymore.
Yeah.
You don't want to be with Arbitrum. Vitalik said L2s are useless the other day now, and he doesn't think it's working. You want to be where the money wants to be, and it moves fast. So.
Yeah. Well, that probably leads me on to something that I really want to tap on. The biggest mistake people make is thinking that they understand markets enough to outcompete, and going in without guidance. So many of our clients that come to us, probably the first reality check that they get is, wow, I didn't realize how much more there was to this than what I knew.
Yeah.
And so it doesn't really make sense at all to be trying to tackle this, trying to build your own strategy, putting your hard-earned money into the market without proper guidance and strategy. So, obviously we're going to be biased and come to us, but honestly, go to anyone that you see that is giving proper guidance and seems to have getting good results year on year. Don't just go into, because something a mate at the pub told you that XRP is going to do this or Bitcoin's going to do that. You really, you need to be guided and have proper strategy in place. And the market moves so quick, doesn't it? I mean, you do this full time, Mitch, day in, day out. And, even you'd be tested on days of, did I get this wrong? Did I get this right? Is the narrative going this way? What's going on? So, make sure you seek proper guidance and you're surrounded by good people.
Yeah, 100%. I think it just, once again, comes back from this cycle being different to last cycle. You could have got away listening to your mate at the pub last cycle. Everything went up. We had QE. Like, you could have plonked in 50 different coins. Like, when Bitcoin went up, when Ethereum went up, when alt season happened, because we used to have alt seasons. Great. You were an expert. You were great at doing what you're doing. None of those people have made money this cycle. You haven't been able to just park in anything unless you got lucky. And
the charlatan experts, they disappear as quick as they were loud.
Literally.
Running around the streets saying, "Oh, I told you to get this and I told you to get that." Trump coin was probably the classic. All these people message, "Did you buy it? Did you buy?" I was like, "Nah." Like, aren't you meant to be a crypto expert? It's like, yes. Like, it's probably going to come down as quick as it came up. It's a pure gamble. Good on you if you put in a little bit and you got it out. That's probably not bad investing, but there's better areas to make money.
For sure.
I think awesome conversation today because, we've covered here how the market's been different. We've covered off why the market actually crashed. We've covered off a good map for people to follow the areas that they can be watching. We've covered off strategy that they can be using to dollar cost into those areas. The big mistakes that people can definitely avoid. I think this is a really good episode for people to get a lot out of. And any final notes?
Maybe some people listening to this, they think, wow, I'm trying to follow along. It's a bit more extensive. It's even more extensive than that. And if you need that helping hand, feel free to reach out to us. We onboard you. You can have a one-on-one client review with me for your current portfolio and whatnot. And then really we've got research reports and everything to help you from there. So as Will said, this market is no longer able to be tackled alone. I even have mentors. I even have other people I rely on for analysis and data. I don't do this alone as well. Not everything comes from my brain and my mouth. I get assistance too. As we've said, most people emotionally or psychologically check out right now. And I think one thing that startled me this morning was the fear and greed index is at 5. The fear and greed index never went to 5 last cycle in the bear market. FTX, Luna, the low was 6. So right now at 65k BTC, there is worse sentiment and worse fear in the market than there was at 15k BTC. So think about that for a little bit and understand the best time to get involved in crypto is not at 126k. It's when these altcoins are completely down. It's when Ethereum has slashed its price in half in the same time frame as well. And you want to have these, you want to get involved when others are fearful, and you want to sell when others are greedy. So yeah.
That's it. Link in the description if you want to get in touch. I think unbelievable value. You speak to Wilson first, who's one of our account managers, to understand what we do. You then get, if you decide to go ahead with us, you get to speak to Mitch directly, go through your portfolio it is now, or if you're new to the market, how you start positioning into it. And you get to get exposure to the best asset in the world, Bitcoin,
Exactly.
and some cryptocurrency. So awesome chat, Mitch, and we'll see us in the next one.
All right, thank you.
Thanks for tuning in to Crypto Coach Will. If you got value from today's episode, then make sure to subscribe so you never miss the latest tips to navigate the crypto market. If you're ready to take crypto investing to the next level, check out the links below where you can book in a call with my team of experts. We place strong emphasis on educating before investing in the market, so take advantage of the knowledge they have to share. Don't forget to follow us on socials @CryptoCoachWill, and I'll catch you in the next episode.